This week we're going to have a review of markets, a look at the central bank activity in respect of interest rate rises, and also a deeper look at inflationary trends in the UK. Markets remained resilient last week despite the uncertainty caused by the UK election. Both the US and UK markets traded flat. Where we did see some interest, however, was in the US, where the technology names suffered a sharp sell-off. The so-called FANG stocks, Facebook, Amazon, Netflix and Google, saw nearly $100 billion wiped off their market value. We don't see this as a cause for concern, however, and in fact would see it as probably some much-needed profit-taking after a very strong start to the year. Technology stocks remain a core part of Coutts' portfolios, where we still look to their superior growth prospects over the longer term. So last week, the US Federal Reserve, the Fed, raised interest rates in America by a quarter point to 1.25% and gave us clear indication that further rate rises will come later through this year. This was largely expected by markets and shows the continued strength of the US economy. In the UK, the Bank of England Monetary Policy Committee met last Thursday and agreed to leave interest rates on hold at 0.25%. Whilst this was expected, there was interest in the debate as the vote was much closer than expected, with 3 members dissenting and voting to raise interest rates. This shows that members of the committee are becoming increasingly concerned by rising inflation, despite the fact that economic growth in the UK has started to slow down. After a period of low inflation, prices are on the rise in the UK. Last week's data showed that inflation in May rose to 2.9%. This follows a 2.3% rise in March and a 2.7% rise in April. Significantly, this shows that prices are rising much faster than wage growth. The contributors to the rising inflation have been airfare increases, oil prices, and also energy costs. Overall, Coutts don't expect inflation to rise significantly above 3%, particularly given the data that suggests a slowdown in retail activity in the UK. Coutts' portfolios are positioned for a modest rise in both interest rates and inflation going forward. We have an underweight position in gilts and treasuries, which are typically more sensitive to interest rate rises. Instead, we prefer shorter-dated corporate bonds. We're also invested in alternative investment strategies, such as UK commercial property, which provides us with a hedge against rising inflation. We continue to favour equities, which tend to perform best when inflation is in the 1 to 3% range. Companies typically have the ability to pass on price rises to consumers, protecting both margins and shareholders.